A change in the state of delivery occurs when bullish momentum suddenly shifts to bearish, or vice versa, signaling a potential market reversal. This shift presents an opportunity for traders looking for higher risk-to-reward ratio trades. In this video, we'll explain what a change in the state of delivery is, the rules you need to follow to apply it correctly on a chart, and how to combine this theory with other smart money concepts to enter high-quality trades. So if that's something you're interested in, make sure to hit the like button to show your support. And don't forget to subscribe to our channel if you're new here. See you after the intro and disclaimer. So, what exactly is the change in the state of delivery? CISD is a reversal pattern in which the price's momentum shifts direction suddenly. In this example, you can observe a clear bullish trend. These three candles represent the most recent bullish momentum, which has broken above the latest market structure. This can also be referred to as the most recent buy-side delivery. We mark the body of the first candle as a reference point for the beginning of this upward movement. The structure is clearly bullish, and after a short-term correction, we anticipate the price to continue pushing upward. However, if the price suddenly drops and closes below the demand area, showing a complete reversal of bullish momentum, this condition is known as a change in the state of delivery. So, what does this signify in terms of price action? First, it indicates that the breakout was actually a fake-out, designed to target liquidity above this market structure level. The buy-side delivery triggered the buy-side liquidity, which was then followed by a bearish movement to complete the market maker model. A break below the demand level reveals that buyers failed to support their long positions, and sellers have now taken control. This reversal pattern signals a potential shift downward in the market. So, how can we use this concept to enter a trade? At this point, our market bias has shifted to bearish, meaning we are only looking for opportunities to sell. After observing a break and close below the origin point of the buy-side delivery, we know that what was once support has now turned into resistance. This change in market structure provides us with an important signal. When the price pulls back to this resistance area, it creates a great opportunity to enter a short trade. Since this zone, which was previously a support level, now acts as resistance, the chance of the price rejecting this level and continuing downward increases. By entering a short position at this point, we can take advantage of the bearish momentum, giving us a high-quality trade setup with a good risk-to-reward ratio. It's important to be patient and wait for the price to return to this resistance area before entering the trade. This increases the chances of catching a strong downward move while keeping risk low. The same concept applies to the bearish scenario. A CISD occurs when price suddenly shifts momentum and breaks above the most recent sell-side delivery after sweeping the liquidity below a key low. This indicates that sellers are no longer in control, and a potential reversal is on the horizon. Once the price pulls back to the previous supply area, it offers a high-quality entry point for a trade. Although similar, the change in the state of delivery and change of character have some key differences. Change of character happens when the price breaks through a well-defined market structure, signaling a shift in the overall trend. Change in the state of delivery, on the other hand, is more focused on a sudden momentum shift to the opposite side and can signal a market structure shift earlier than a change of character. However, it's important to note that not every change in the state of delivery pattern you see on the chart will lead to a successful trade, especially if it occurs in the middle of nowhere with no clear structure or context. To trade CISD effectively, it must align with other market factors and conditions. Through backtesting, we have realized that CISD patterns are most effective when accompanied by specific conditions. To ensure a valid CISD and to enter a high-quality trade, certain rules need to be followed. So let's discuss the key conditions that enhance the reliability of a CISD pattern. Rule number 1. Rejecting a higher timeframe key level. As mentioned earlier, the CISD is a reversal price action pattern, and it's most effective when it occurs after the price has tapped into a higher timeframe key zone. This is because key levels on higher timeframes, such as 4 hours, daily or weekly, have the power to influence the price movement significantly. When the price reaches these zones and a CISD forms, it indicates that the market is likely reversing at a crucial area, making the pattern more reliable. Without this higher timeframe confluence, the CISD could occur in an area where the market isn't likely to experience a meaningful shift, reducing the trade's probability of success. Rule number 2. Sweeping a liquidity pool. A high-quality CISD setup often occurs after the market sweeps liquidity from one side. Liquidity pools form around obvious equal highs and lows where traders place stop losses. When the price sweeps these levels, it triggers those stops, engaging liquidity and setting up a potential reversal. Once this liquidity is taken out, the price is more likely to reverse in the opposite direction, making it an ideal condition for a CISD pattern to form. This is a strong signal that the market has gathered enough momentum for the reversal, increasing the validity of the setup. Rule number 3. Volume and confirmation. For a valid CISD setup, it's important to see an increase in trading volume during the price action shift. Higher volume shows that more market participants are involved, which strengthens the momentum and confirms the pattern's validity. Entering a trade based on a CISD without volume confirmation can be risky, as it may indicate a weak move with no real market backing. This increase in trading volume can often be identified through the formation of fair value gaps. FVGs occur when there's an imbalance in price caused by aggressive buying or selling, leaving gaps on the chart that indicate high momentum. These gaps are a visual representation of heightened activity and volume in the market. When you spot a CISD forming alongside a fair value gap, it provides a clear sign that institutional traders or large participants are behind the move, adding further credibility to the setup. A price retracement into the fair value gap can offer a high probability entry point. The market often fills these gaps before continuing in the direction of the new trend. By combining volume, fair value gaps, and CISD, you can significantly increase the likelihood of a successful trade while minimizing risk. Rule number 4. Waiting for the pullback to the broken level. After the price breaks through the origin point, it's crucial to wait for a retest. This retest serves as confirmation that the previous level has now flipped, either from support to resistance, in a bearish scenario, or from resistance to support, in a bullish scenario. Entering on the pullback improves your risk-to-reward ratio and gives you a clearer signal that the reversal is valid. By following these rules, ensuring the CISD occurs at a key level, watching for volume confirmation, and waiting for a retest, you increase the chances of identifying high-quality trade setups with strong potential for profit. Now that we have explained what the CISD pattern is and the rules required to apply it effectively on the chart, let's take a look at some real chart examples to see how these concepts work in practice. But before we continue, if you're looking for a platform that keeps you updated with financial news and fundamental analysis, we recommend Fastbull, one of the leading trading websites, offering unique tools to keep you ahead of the market. Fastbull provides an accurate economic calendar, real-time market data, and a 24/7 trading question and answer service that allows you to receive free expert opinions and analysis, helping you sharpen your strategies with professional insights. Additionally, Fastbull has recently launched an exciting trading contest, offering incredible prizes for the winners. So if you're interested in participating in this exciting contest and benefiting from powerful trading tools, check out the link in the description. Here we have the Eurodollar on a 15-minute chart. We can see a bearish market structure where the price has recently broken below a key level that had acted as support multiple times. If we analyze the latest impulsive movement that caused this break, we notice strong bearish momentum, shown by the creation of a fair value gap. This suggests that sellers have successfully broken through the support level and taken control of the market. From a price action perspective, if we get a pullback to the former support, now turned resistance, we can anticipate a rejection, potentially leading to further downside movement. However, what followed was a strong bullish move with FVGs that broke above the resistance area. This sudden shift in momentum signals a change in the state of delivery and a potential reversal. Additionally, this breakout appears to be a fake-out, designed to target the liquidity resting below these equal lows. So how do we approach this market now? According to our trading plan, we mark the opening of the candle that started the bearish order flow as a key level. When the price returns to this level, we anticipate a rejection and look to enter a long position. However, before entering, we need to zoom out to a higher time frame, such as the 4-hour chart, to get a better understanding of the overall market conditions and confirm the bigger picture. Let's zoom out and analyze the 4-hour chart to better understand the market conditions and see if this reversal aligns with the broader trend. On the 4-hour chart, we can observe that the price has tapped into a key level. A small reaction to a higher timeframe key level can signal a major trend change on the 15-minute chart. With that said, the higher timeframe analysis confirms the upward movement seen on the 15-minute chart. Our higher timeframe target could be this level of market structure just ahead of the current price. Now let's return to the 15-minute chart. According to our trading plan, we can set a buy limit a spread size above the origin point, with a 2-to-1 risk-to-reward ratio. Our stop loss will be placed somewhere to protect against market fluctuations. This is how we can apply the CISD pattern alongside multi-timeframe analysis and other price action strategies to enter a high-quality trade. However, no matter how promising the trading setup looks, the market can always move in unexpected ways. That's why it's crucial to have a solid risk management plan in place. This ensures you can protect your capital and take advantage of profitable opportunities when the market turns in your favor. Here on the Aussie dollar 15-minute chart, this area has acted as support multiple times. Traders who went long likely placed their stop losses below this support area, which means there is a large amount of liquidity gathered beneath this level. Now let's see what happens next. The price breaks through this area with strong bearish momentum. The fair value gap created during the move suggests that the price has finally managed to break through the barrier, signaling a push lower. However, the price immediately returns to the range, forming another bullish FVG. This scenario reflects a complete change in the state of delivery from bearish to bullish. It shows that the breakout was actually a market maker engineered move targeting liquidity below this key level. With the sell-side liquidity swept, it's now time for smart money to go long, aiming for the buy-side liquidity located higher up. Now that we've identified the direction, we want to go long. But the question is, where should we place our buy limits? According to our trading plan, the start of the last bearish move could serve as support and a good entry point for a long position. Additionally, the fair value gap formed during the pullback could also act as support. Whichever entry point we choose, the stop loss should be placed below the FVG for protection. We will target the recent highs as our take profit levels. Now, let's see what will happen next. This is a perfect example of how the change in state of delivery can be identified on the chart, and how it differs from the change of character. A change of character occurs when the price breaks through a strong market structure, signaling a shift in the market's overall direction. This shift can happen slowly or suddenly with strong momentum, but the key factor is the break of an important structural level, indicating that buyers or sellers are taking control. On the other hand, the change in state of delivery focuses more on a sudden shift in momentum, where price transitions from bearish to bullish or vice versa. Unlike the change of character, which can take more time, the CISD is identified by the quick change in price direction and is confirmed when the price breaks the origin of the last movement. In essence, CISD gives an earlier signal that a potential reversal is occurring, often before the larger market structure confirms it. Combining CISD with liquidity concepts, such as liquidity sweeps and fair value gaps, further enhances the quality of the trade setup. For instance, when a CISD occurs after liquidity has been swept from one side of the market, it signals that the market has gathered enough liquidity to reverse, making the trade even more reliable. This approach allows you to enter positions with higher confidence, as they are aligning their entries with both momentum shifts and key liquidity levels. By understanding both concepts, CISD and chalk, and using them alongside liquidity analysis, you can refine their strategy and improve their chances of entering high-quality trades with better risk-to-reward ratios. Guys, don't forget to backtest this strategy and see how it works for yourself. If you enjoyed this video, please give it a thumbs up, as it really helps support us in creating more content like this. Thanks for watching, and we'll see you in the next episode.